Hi there, John Hardy here with the FX update on Monday, April 18th, and our title today, Mr. FX Meet Mr. Volatility. We're seeing quite an acceleration in volatility today after very important events over the weekend. Of course, that being the Finnish election, which saw this political party, the True Finns, gaining 19% of the vote, a rise from only 4% at the previous election. And as we've mentioned in several pieces we've covered on the trading floor, this is important because especially the Eurozone, to enact any kind of new measures, needs to have unanimous votes, and that would include, of course, Finland being a member as well. All votes related to the Eurozone initiatives, when voted upon, or when the Finland has to vote whether to take part in them, it's not the government, it is the entire parliament that votes. And of course, the True Finns gaining such a large percentage of the vote is remarkable. They are dead set against any kind of a bailout extensions beyond what's been done so far, and other parties, including the Social Democrats, are leaning that way as well, though not quite as hard line on the matter. And this is getting a lot of attention, as it should. And we've seen finally this transmission of the pigs, the S in the pigs joining the previous trio of smaller countries, where we saw the euro rising because the idea seemed to develop that, well, these three countries can default and that's contained, and the rest of the Eurozone would be able to handle it, and that's where the transmission stops. But clearly the last several days have seen that scenario derailed, and this is why we've seen a Eurodollar that's quite weak today, off a couple hundred pips from the levels we were seeing Friday. So we'll get to the charts in a moment, but that's obviously what's shaking the euro. And then early this morning we see the U.S. debt outlook being downgraded to negative from stable by the S&P, and this caused all kinds of tremors as well. At first, bonds selling off sharply, risk off very sharply as well. Bonds did recover in the U.S., but bunds in Europe really accelerating strongly on the double whammy of people playing the spreads again, bunds versus other European nations, but as well perhaps putting on trades on bunds, long bunds, short treasuries on that spread. So quite an interesting acceleration there. The yen really getting excited about this and strengthening quite a bit on the day as well, as we're seeing that yen long treasury correlation still quite strong. Of course, we did see U.S. Treasuries posting a new high on the day despite the downgrade, so pretty interesting there. We had precious metals all over the place. It looks like they're settling the day close to their all-time highs. Silver was down as much as $1.30 or so, and now it's back towards $43.50, an incredible price there, and $1,500 almost on gold. Interesting though, copper, it traded down to a new low for April, and it has recovered some of its ground as we've seen risk appetite bounce a bit, but it is still below that previous low. So that's an interesting divergence there in the price of copper, which does have some financial aspects as we've covered in China, but is of course traditionally at least considered an industrial metal. Themes going on right now. Well, we did have a much stronger dollar today, but if we look at sort of the pure risk plays, what traditionally had been pure risk plays like Aussie dollar, etc., the weakness in or the strength in the dollar is not really holding all that well. In fact, in this bounce later in the day, we're seeing the likes of dollar Canada, the air coming out of that one. Aussie dollar is really not down that much considering what we've seen elsewhere, and even the Kiwi dollar bouncing very strongly from the bottom. And this is, of course, still related to the risk appetite markets, but certainly with the S&P making it official, the theme out there still, the U.S. is doomed. U.S. dollar is doomed as long as this Fed is about threatening to print money, and as long as the political debate has no credible solution, or as long as the rhetoric isn't even suggesting that a credible solution is out there, this is a very big worry. I think the only chance for the dollar is that externally things suddenly look very bad, and that the market is already extremely short the dollar. That's about its only hope for a comeback, and that would be in the short to medium term. Longer term, of course, the bigger issue being is there ever any fiscal credibility there, etc. Just an anecdotal report. We have an interesting New York Times article out about China. there was a quote in there, or a section in there, talking about the prices of housing. Some city named Chengdu, I don't even know where the city is, but basically the statistic mentioned that the average house price is 25 times the average local salary. Now, I think general traditional loan requirements are about 2.5 times that a person should not lend more than about 2.5 times of annual income. So 25 times, we're looking at something extraordinary. And other reports we've seen suggest that half of, in the major Chinese cities, half of apartments are empty because they're being used as storage of value due to the lack of credibility and keeping money in cash. So at some point, this just goes to show you that there are little pinpoints of data you can pull out without understanding some of the sort of opaque things that are going on in China with their banks, with their economic data, etc. But you pull out a data point like this and you realize that something quite dramatic is going on, and that some kind of adjustment is required, if nothing else, at least in the property market, and that should have some kind of implications for materials, for the Aussie, etc. In any case, economic reality does eventually have to mean something, even in China, where these kinds of bubbles, these kinds of imbalances can continue for far longer than they can elsewhere, because you have a sort of a command-style economy where things can be manipulated for longer without the market sort of establishing itself more quickly. So keep that in mind. Of course, we're a bit dubious on how China transitions to a smooth landing as it tries to come out of this inflationary situation it's in. We also have this cognitive dissonance in bonds versus everything else, including the dollar. If the dollar is doomed, why are we seeing such a rally in treasuries? Why are foreign banks still interested in buying it? If we're devaluing here and we're going to have hyperinflation, why are people buying bonds? So there's certainly a cognitive dissonance there. At the same time, we are seeing the trade of inflationary worries, et cetera, in the precious metals as we speak. So really, the market message here rather garbled. We did say on Friday in our report, keep in mind, we don't take things like this lightly, and especially when we see the bond market moving. It really often, to me anyway, seems to move before other markets. And we asked whether it was compatible with the high commodity prices, and indeed we've seen a bit of an adjustment. I had a little quote I was going to pull up on what we were saying on Friday. Yes, here it is. For the moment, we were saying this Friday morning, U.S. time. For the moment, the salient market feature as we are heading into the weekend is a very strong bond market, which flies directly in the face of the themes the macro picture has been pumping for many weeks now. The idea, currency debasement, and rush to buy hard assets. So far, this has only partially been taken as a risk-off signal elsewhere, equities, etc., but from where we sit, we wonder how long that can remain the case. The bond traders are more often right. So keep that in mind. I think bonds are often a leading signal in the marketplace. Looking ahead, 55-day moving average in S&P 500 has been broken. Is this significant, or is this a one-off spasm created by the S&P announcement? And all things being equal, the S&P announcement doesn't trigger anything except perhaps mentality-wise. This was a situation that was obvious to everybody for months, if not years. I would suggest that the Euro situation was actually more of the reason for what's going on today, the Finland elections, etc. We have Goldman Sachs earnings tomorrow. We need to pay attention to that because Goldman Sachs is one of the big movers in financial markets, and other big tech and other bellwethers are also out this week in the U.S. So keep abreast of earnings reports. Preliminary European PMIs tomorrow. Seems like we have to see a slowdown at some point, considering we've been at near record levels for a number of months, and some pressures from commodities, etc. But let's wait and see. U.S. housing starts and building permits. Not suggesting we're going to see anything worth getting excited about there. We do have the Easter weekend coming up. Be aware of that. Friday for most countries is a holiday. And the next FOMC meeting is next Wednesday. Now, I briefly wanted to take a look at some other charts I was making for an investment-related meeting because I thought you all might find them interesting. Allow me to adjust the screen a little bit. I did not create these in a broad format because there's a normal PowerPoint presentation. So yes, we do have the euro from a rate spread perspective suggesting the euro dollar should be trading at new highs. We did see, however, this consolidation. Why? Well, we've been talking about why, and that's because the spreads have massively widened in Italian, for example, Italian and Spanish debt spreads versus the Bund. And look how much this has come off all the way back to sort of the widest levels we were seeing really for the whole year, almost, at least back to late January. And that's an important drag on the euro. That'll need to be straightened out before we can see the euro, everything else being considered, see the pressure taken off the euro. This would take a little bit too long for me to explain, but it just shows the carry trade index, which is in red, our number of risk factors that we measure. And when we saw the top of the market in mid-08 here, it was a local top. Of course, the all-time top was earlier. We were seeing some divergence in the risk factors, a much lower peak here. Just wanted to point that out. And that was leading into the huge declines that took place. Now, the actual low, this is what's important is when the red line, the carry trade related risk factors are below zero. It's the most important thing, as much as the absolute direction. And the absolute bottom in the market came as this was rising, but it was still worsening, just at a very slow rate. By the time it bottomed out, we were back at neutral, back at zero on the risk factors, and some very strong indications that, at least for the time being, there was all clear in markets. Again, we saw a hiccup here back last April, May, and now we're seeing quite an extension in the carry trade with the dollar. Now the question being, can the dollar come back anymore? Is this the same kind of market, or is the dollar completely doomed, and even risk coming off can't support it? We certainly saw some signs that were worrisome the last time around. We had the March 11th, post-March 11th situation, a pretty big hiccup in risk, as we see here, and the carry trades hardly responded in terms of the versus the dollar. So that was a key worry, I would say, and we're going to have to see the next time around we get one of these things. If the dollar doesn't respond, then we really need to worry about the dollar's trajectory. In any case, we do have some divergence here. So for carry trades in general, suggesting some risk, although we're still above the zero level on our overall index. And again, to really get the full risk off signal, I'd want to see it down below zero. This is a bit of a slow index. Our faster index is a bit lower on that measure. As a reminder of where we are on the VIX and volatility fears, complacency near record levels for the last couple of years. It was only been lower for a brief time. I think it was back in 06. Just incredible low levels on the VIX. So a reminder on that one. And here we have Treasury bond yields and the S&P 500. Obviously a correlation here, both taking off at the end of August. Jackson Hole speech from Bernanke. We've seen a bit of a bigger sell-off here, or a rally really, a drop in yields that hasn't been confirmed yet by the S&P, and we'd like to see that if that correlation holds. Here we have gold positioning. Now, this is nothing scientific at all. I just find it interesting that as we've rushed to new highs here towards 1500, that the positioning is lighter than it was in terms of the speculative longs. This was last week's chart. If I include the data point for this week, we get the long reading about right here. So it's still divergent, but just not as low as here. But still, the overall drop is still quite clear, despite the new high in spot. So interesting to see that development as well. Of course, the critical bond market, this 3.75 to 4% area in U.S. 10 years, absolutely key. It's held basically since the financial crisis, and we turned around at 375 this time. Had an engulfing week here. I know this is too small for you to see, but this will need to be re-engulfed, if you will, to put the whole bond market fear situation back into play. On equity sentiment, previously we saw these big peaks in bullishness versus bearishness right at the market top, so almost perfectly timed. And then, of course, here the record bearishness almost as the market bottomed in March of 09. Here we saw a dramatic peak, and the secondary peak was lower in sentiment but higher in price, and that was actually an interesting signal for some time or a reasonably long period of consolidation. We wonder whether this is the case again. Incredible bullishness to bearishness ratio. The recent run-up that did not announce a top, but now and then we've seen a matching of the highs almost in the recent high, but the bullishness ratio is far lower. So that's an interesting slide there. At least I find it interesting. And let's see what happens going forward. It seems like, in other words, we've come out of a very incredible complacency cycle. Looking at a couple of charts, that's BHP Bulletin. This is what we use to correlate, or it's highly correlated with the Aussie. Seeing a reasonable comeback today from the lows, but still a drop from the Friday close. S&P 500 below that 55-day moving average, which has obviously been key on a number of occasions. Keep your eye on that. Here are bunds going absolutely mental to the upside on the situation among the Eurozone sovereign debts. The sovereign debt spreads widening, of course, people buying bunds and selling perhaps Spanish, Italian, and other countries' bonds. I had another chart here which shows where Greece has gone. Now, on this run up in yields in Greece, this is the 2-year. We saw euro actually strengthening because, again, back then the idea was it was limited to just the 3 smaller countries. This time around, it's meant more because we're also seeing transmission to Spain, etc. So be aware of that. Even seen a rally in the Euribor. So people taking out, let's say, about 12 bips of forward hikes out of the ECB's forward curve. You see the Bank of England forward rate predictions also going to the record lows really for quite some months. So that's very interesting. Regardless, the sterling rallying because of the whole nervousness, obviously, with sovereign risk, etc. Going backwards in our charts today, oil off a bit, though it's made a bit of a comeback with the comeback in risk. Emerging markets back and forth, mostly back on the risk off. Biggest down day in Kiwi for a long time, but coming off the lows as we're seeing a late day bounce. We've seen almost the entire, or at least 2/3 of the sell-off in the NASDAQ and tech stocks, for example, taken out. It's a remarkable buy the dip mentality. Just shows how strong the build-up of this run-up in risk has been. Aussie was off further, now it's back up, and not that big of a sell-off, still within the range. Dollar Canada likewise, it actually broke the new highs, and an important line going back at around 96.75 and then dropping back below it, so not really able to make a definitive statement on the day. The statement in Eurodollar, however, more definitive, as we've seen this 42.50 level broken. Not drawn terribly well in here, that's more like it there. And this trend line challenged looks pretty ugly, and especially if we keep an eye on sovereign debt risks today. Sterling doing more strongly because of the euro-sterling sell-off, so the sell-off has been, and cable has been lighter, and found support at that 55-day moving average, obviously a very important one, going back a couple months there. Euro-sterling really looks like a turnaround candidate here after this, what we're showing signs of nervousness above the old highs, 88.50 or so, coming off, and we're seeing the full-scale sell-off today, and that really looks like it's going to cap the chart at least back to 86.75, and let's see if we break fully back into the lower range after this. Strong bond market equals strong Swiss, safe haven flows, get out of the Eurozone, etc. That's what we're seeing there. Back really to the lows, if we take out the whole Japanese catastrophe, that's about where we were at the lows for the better part of this year, since early January anyway, so this is an interesting level there. Euro-yen off sharply as well, of course, with very strong bunds. But dollar-yen finding support at a key area, 82.50, that being the Ichimoku and 55-day moving average. Let's see if that holds. I think that's really key for sort of keeping this whole rally sequence, or continuing for it to have any meaning. We need to find a rally here soon, and that would entail bonds selling off again. So that'll be an interesting one to see if it holds. Quite a mouthful today. I hope you enjoyed it, and especially the special slides we had up that I think are worth looking at. That'll do it for today, and we'll see you back as soon as possible with another edition of the Saxo Bank Video FX Update. Over and out.